Welcome to the Tax Savvy Financial Planning webinar. If your screen is not loading, please refresh your screen. Please make sure that your view is in participant mode. I'm Patrick Donahue, Marketing Specialist with the Congressional Federal Credit Union and your moderator for today's presentation. Congressional Federal Credit Union provides innovative and affordable financial products and services, education, and community outreach to the Congressional Federal Credit Union family, which includes the House of Representatives, Congressional Support Offices, and functions on Capitol Hill, in addition to affinity and non-affinity select employment groups. Established July 9, 1953, by 8 congressional employees with just $40 in deposits, we have grown to over 47,000 members and still counting. Congressional Federal has developed a reputation as a trusted credit union based on its proven track record of reliability with its members. Our presentation today will run about an hour, including time for questions and answers at the end of the presentation. Please feel free to enter your questions into the Q&A pod at the top right of your main screen. This presentation is being recorded, and an archival link will be emailed to you within the next couple of days. Today's presenter is Michael Hallstrom. Michael is a wealth advisor at Congressional Federal. Since entering the financial industry in 2007, Michael has specialized in providing comprehensive financial advice with concierge-style services to individuals and families. Michael spends time educating his clients and helping them make purpose-driven financial decisions while covering all areas of personal finance, from cash and debt management to investment and retirement planning, asset protection, tax management strategies, and estate planning strategies. And now I'll turn this presentation over to Mikhail.
All right, thanks, Patrick. Hope you're all having a good start to your Wednesday. Again, I'm Michael Hallstrom, and I'm the Wealth Advisor or Financial Planner for Congressional Federal Credit Union. My job is to help our members build toward their future financial goals, make sure that they're on track for retirement and really anything else that you're planning on achieving long-term in terms of your finances. So to start out with today, let's begin with just discussing a quick agenda. We'll have a 3-part agenda here today. First, we're going to discuss the major changes to the tax code for 2018. As you may have heard on the news, there's been a lot of different changes to how taxes are going to work for 2018. And we'll discuss kind of the major things that are going to affect most households this year. I'm not a CPA, so I can't actually crunch your specific tax numbers, but we'll go through the major changes, the facts and things, and if you have questions on those overall changes, there will be time for Q&A at the end where you can dig a little bit deeper. So second, we'll discuss strategies that help manage your long-term tax liability. One of the things that we do as financial advisors for our members is make sure that we're developing strategies that put you in a spot where you can pay as little income tax as possible long-term. So not just getting stuck on the here and now and how much money we're paying in taxes this year, which is still important, but looking at the grand scheme of things, your entire lifespan, how can we reduce taxes long-term? So we'll talk about those strategies in the second part of our discussion here today. And then third, we'll go into a Q&A session. During that Q&A session, there will be a little chat box that pops up, and you will be able to type in questions, and we'll respond to your questions. So some ground rules for today. First and foremost, please don't put us on hold. Your hold music might come on depending on what phone you're on, and that might be distracting for some of the viewers here today. Q&A at the end, again, I already said there will be a chat box that you will be able to type in your questions at the end. So jumping right into it, let's start with the standard deduction and personal exemptions. This year, the standard deduction actually is going to be nearly doubled, up to $12,000 for single filers. And then it'll be $18,000 for heads of household. That's married taxpayers filing separately. And then $24,000 for married taxpayers filing jointly. So some big increases to the standard deduction. And again, the standard deduction is a deduction choice that you have if your say your itemizable or your deductible expenses don't add up to a significant amount or don't add up to more than what the standard deduction is, you can just take the standard deduction instead and lower your taxable income that way. So the big increases here are actually putting most households in a spot where they will, in fact, just take the standard deduction rather than itemizing like they have in the past. The law also repeals the deduction for personal exemptions. So for many families, this can be balanced by the higher standard deduction and increased child tax credit. But families with 3 or more dependents ages 17 or older may see a negative impact. There's still a $500 deduction for college students and other dependents that aren't qualifying children under age 17, say an elderly parent that who's living in your home and you're taking care of, they're dependent on you, so that still will be around. Moving on here. For 2018, here's the new tax brackets. This was, again, a big overhaul. It's still a marginal tax rate system, and the first tax bracket is still 10%, but every tax bracket from there on forward is actually lowered a little bit. So previously, the tax brackets went 10% and then 15%, then 25%, and then 28%, and then 33%, and then 35%, and then 39.6%. And these numbers here were actually a little bit smaller as well. So for the previous highest tax bracket in 2017, 39.6 is the rate, but you only had to have around $400,000 of annual income to get up into that tax bracket. So a little bit smaller for people who are filing single, a little bit larger for people who are filing joint, but again, taxes are lower pretty much across the board for most households. So moving on here to some common deductions and tax credits. To start out with, let's just define what a deduction versus a credit is. A tax deduction is actually an expense that you're able to deduct or a contribution to a retirement account, for example, that you are able to deduct from your overall taxable income from the year. So it just lowers the amount of income that you're able to be taxed on. And then a tax credit actually reduces your tax bill dollar for dollar. So big difference there to differentiate between deduction and credit. And then there's going to be, for 2018, some taxpayers may also be eligible for the American Opportunity Tax Credit. This provides a $2,500 tax credit for the first 4 years of a student's tuition and fees, but the student must be enrolled at least half-time to receive this credit. Second, there's also the Lifetime Learning Credit, which is a potential $2,000 non-refundable credit that students in undergraduate, graduate, or vocational schools can qualify for. However, for both of these credits, income limitations apply. So talk with your CPA, whoever you're consulting with for taxes, to determine whether or not you're eligible from an income standpoint, because you can be phased out of eligibility if your household makes too much income. So back to the standard deductions, the different things that you can deduct. Some common deductions here are mortgage interest, property, state, and local taxes, student loan interest, medical expenses, and then charitable contributions. So getting a little bit deeper into each one of those, we'll start with state and local taxes. So the combined itemized deduction for state and local property taxes and state and local income taxes is actually limited to $10,000 for 2018. Previously, it was unlimited, so no matter how much you had in property taxes or how much you had in state and local income taxes, you could add that all up and deduct all of that from your taxable income. For 2018, it's going to be capped at $10,000. So again, big difference in planning for for deducting state and local income taxes and property taxes in 2018. Moving on here, for home mortgage interest, a big topic of discussion lately with our mortgage folks here at Congressional Federal has been that the amount that you're able to deduct for mortgage interest has been reduced. For most households, you won't be affected much by this because most households don't have a mortgage that's over $750,000 in balance. But for those that do have mortgage debt, maybe between multiple properties that adds up to more than $750,000, you're only going to be able to deduct the interest associated with the first $750,000 of mortgage debt. Previously, the cap was $1 million, so that's reduced. And then for married couples filing separately, what you're going to do to get the $750,000 total between the two of you is each of you can apply for a maximum of $375,000. You'd be deducting the interest associated with the first $375,000 of mortgage debt each. And then big caveat here that you need to know is that for debt incurred on or before December 17th, 2017, actually the prior $1 million limit will still apply. So the reduction, the $750,000 limit, that's only going to be for debt incurred after December 17th, 2017. A lot of folks weren't aware of that, so keep that in mind as you're making decisions around home financing. Next here, the deduction for home equity interest won't be allowed at all anymore. So if you have money on a home equity line or a home equity loan, a lot of people use home equity lines of credit as a safety net for emergencies, or you might use a home equity loan to do a remodel on your home, a kitchen upgrade, bathroom upgrade, what have you. So the interest that you have been paying on any balance on a home equity line has been deductible in the past, but that's going away completely for 2018. You used to be able to deduct the interest on up to $100,000 of home equity indebtedness. So moving along here, the deductible medical expenses. Let's talk about this for a minute. The adjusted gross income threshold for deducting unreimbursed medical expenses is actually going to be retroactively reduced from 10% down to 7.5% for tax years 2017 and 2018. So even for last year, anything over 7.5% adjusted gross income, any expenses that you have that exceed 7.5% of your adjusted gross income are going to be deductible. And again, we're talking about medical expenses. So consult with your tax advisor to make sure that you understand what exactly is a qualifying medical expense. But again, anything over 7.5% of your adjusted gross income is going to be deductible for 2017 and 2018. After 2018, that actually sunsets or goes back to 10%. So for 2019, the expectation is that you won't be able to deduct until the expenses exceed 10% of your adjusted gross income. We'll see what happens in the meantime. Not sure if they will extend that or not, but for now, only plan on it for 2017 and 2018 being just 7.5%. And then the 7.5% AGI threshold also applies for purposes of calculating the alternative minimum tax for each year. So if you're one of those unique households that qualifies for AMT tax, the 7.5% AGI threshold also applies to that as well. So next here, we've got charitable contributions. In the past, for cash gifts going to charities, you're able to deduct up to 50% of your adjusted gross income. That cap is going to go up to 60% for 2018. So just a bit of an increase. Not many people reach that threshold anyway, but it is getting larger. So if you're doing a heavy amount of charitable giving in cash gifts specifically, a little bit more is going to be deductible for 2018. Casualty and theft losses. I thought this was actually kind of interesting. The deduction for personal casualty and theft losses is actually going to be eliminated for 2018, except for in cases of national or federal disaster areas. So there's been a lot of natural disasters recently, hurricanes and fires and things, and so if it's declared to be a federal disaster area and you suffer a loss in that area, you're going to be able to deduct that for tax purposes. But unless it's in one of those types of rare circumstances, you're not going to be able to deduct that anymore. Miscellaneous itemized deduction. So this is one that's kind of overlooked pretty frequently. So a lot of people weren't aware that they could do this. Maybe TurboTax has been catching it for you automatically anyway. If you use TurboTax or H&R Block or whoever you're using for tax advice, they might be taking into account this automatically for you. But there has been in the past up to you could actually deduct any expenses, any miscellaneous expenses over 2% of your adjusted gross income. If it were, say, tax preparation expenses, unreimbursed employee business expenses, investment advisory or financial planning fees. A lot of our members choose to pay any of their investment advisory or planning fees separately from their retirement accounts. So they're actually writing a check for their investment advisory fee. And as long as the fee is not coming out of your retirement account and you're paying for it out of, with a check from basically out of pocket, so to speak, it has been deductible in the past. So for a lot of households, your tax preparation expenses along with employee business expenses that were unreimbursed and investment advisory fees, it all added up to quite a bit more than 2% of your adjusted gross income. But that's going to go away completely for 2018, so big change there. Moving along, next one to talk about is actually a credit. So we've been talking about deductions for the most part. Now we're moving into the child tax credit. So this is an actual reduction of your tax liability dollar for dollar based on how much the credit is. So the child tax credit for 2018 is going to be doubling from $1,000 to $2,000 for each qualifying child under age 17. The maximum refundable amount is $1,400 per child. And then to qualify for refundable child tax credit, your earned income has to be a minimum of at least $2,500 for 2018. That's actually down from $3,000 last year. So just $2,500 is the minimum earned income requirement to qualify for a refundable child tax credit. And then if you're making a significant amount of income in your, as an individual or in your household, there are income phase-out limits for qualifying for the child tax credit being refundable or not. So that starts at $200,000 for individuals and goes up to $400,000 for married taxpayers filing jointly. And then there's a range, I think it's up to $220,000 for individuals and then $420,000 for married taxpayers filing jointly where you're phased out completely. So there's like a little phase-out range there starting at these levels for a refundable child tax credit. And then last, the $500 non-refundable credit that's been available for dependents who are not qualifying children under age 17. Again, college students, an elderly parent that is a dependent in your household, that will still exist. So $500 non-refundable credit is still available in 2018. All right, so last, before we wrap up our portion of our time together here today where we're talking about major updates to the tax code for 2018, Oops, went too far there. Some changes of note: the Affordable Care Act individual responsibility payment, that's actually been permanently removed, so that has been eliminated. If you don't have the insurance anymore, you're not going to be penalized for that anymore going forward. Then the federal estate and gift tax exemption levels have actually been increased big time, actually. So previously they had been at about $5.5 million for individuals and $11 million for households or for married couples. Those amounts are going up to $11.2 million for individuals and then $22.4 million for spouses. So huge change to the federal estate and gift tax exemption level, which basically means that, you know, unless you are a very wealthy individual, then you're not going to be affected by any federal estate or gift tax upon passing away. So also commonly called a death tax instead of estate tax. But anyway, starting in 2018, Roth conversions also are not going to be able to be reversed by recharacterizing a Roth conversion that you've done back to a traditional IRA. So in the past, you've been able to convert a traditional IRA to a Roth IRA and then reverse that if you found that you needed to. So you're still going to be able to convert Roth IRAs in 2018, but you're not going to be able to reverse it by recharacterizing it once that's been done. So something to note and make sure that it really makes sense for you before you pull the trigger on it. Okay, so that does it for our tax updates section. And again, we'll respond to any questions that you have at the end of our time together. So we've probably got another 15 minutes or so of our portion on helping you identify strategies that can reduce your long-term tax liability, especially as it relates to retirement savings. So we're going to talk about what we call the tax control triangle today. And we have bubbles set up here for each different point of the triangle. So these three bubbles represent a different category for how financial accounts or investment accounts are taxed, different tax treatment between these different categories. So the first point on the triangle, or the first bucket, if you will, is going to be our pre-tax or tax-deferred bucket. Examples of this are your 401k, a 403b, a traditional IRA, your TSP plan if you're a federal employee, or even a pension plan. This is all considered on the pre-tax side of things. Something to note, your pension plan, you pay into a pension plan typically. I know that federal employees do. And so your contribution into your pension plan goes in pre-tax. There's a tax deduction on that portion of your automatic contribution to it. And then when you start claiming the income, you start claiming that pension income in retirement, 100% of it is taxable, or actually a certain portion of it is taxable, but it comes out as a taxable distribution to you once you retire. So again, the most common one is a 401k or a TSP plan that most people are going to be familiar with, or traditional IRA. There is a rule on these types of accounts where you can't touch them until age 59 and a half. So if you've contributed money to TSP or 401k and you need access to it before you turn age 59 and a half, unless it's in very special circumstances like disability or other unique situations, there's going to be what's called a 10% early withdrawal penalty, 10% fee for accessing it before age 59 and a half. And then again, 100% of the withdrawals from these types of investment accounts are going to be taxable as ordinary income when you retire and start taking withdrawals. The next bucket here that we're going to talk about is what we call an after-tax or taxable investment bucket or savings bucket. So examples of this are like accounts, stocks, bonds, or real estate that you might hold in a non-retirement account. So this is money that you've saved or invested after tax, you've already paid money, or you've already paid taxes on your contributions to this type of account. And then from there, as you grow your investment, say you've invested into stocks, as you grow your investment, the gains are actually taxable along the way. Each year you'll get a 1099 form, and that'll tell you how much money in taxes you have to pay, or it'll actually tell you how much in gains you've realized that year, and that'll be added to your taxes when you file for taxes. So because it's taxable every year and it's not tax deferred like a retirement account is, it's like taking 2 steps forward and then 1 step back every year. So it's not as efficient of an accumulation tool for retirement as your typical employer-sponsored retirement plan or, say, traditional IRA. So moving on here, the third bucket here, the third point on our tax control triangle is the after-tax and tax-deferred type of investment vehicle. So here we're talking about your Roth IRA, municipal bonds technically fall into this category, and then actually specially designed life insurance, commonly referred to as cash value life insurance, fits into this bucket as well. So what this bucket is it's a financial account that you contribute to with after-tax money, meaning you've already paid taxes on your contributions, and then the funds actually grow tax deferred, and you pull the money out income tax free when you take withdrawals, typically in retirement. So you do pay taxes on your contributions to them here and now, but then you don't owe taxes on the money again at any point in the future. So it's on basically the opposite side of the tax equation of this pre-tax retirement account like a TSP or 401k. So this little diagram here with the big bucket or the big circle, the medium-sized circle, and then the small-sized circle represents the average household in terms of how much savings they have in each different type of bucket or each different circle. So most people have the majority of their savings in this pre-tax bucket. Some have some of their funds in this after-tax bucket or taxable bucket, and then few people have much money in the tax-advantaged or tax-free bucket like a Roth IRA or Roth TSP plan. It's nice to have some balance between these, though, because let's give an example of somebody who needs $100,000 of annual income for retirement. And so fast forward to retirement, you need to take $100,000 from your investment accounts, and let's say that you only have money saved up into this pre-tax retirement bucket, your TSP or 401k. Tax rates are pretty low right now, actually, believe it or not. Historically speaking, we're in a low point as far as income tax history. And so let's say that your average tax rate is 25%. So if you take a $100,000 withdrawal from your pre-tax bucket, it's taxed at 25%, you're left with $75,000 after tax that you can go and use to spend on expenses and things. Next, let's say that instead you've actually done a good job of balancing some funds between the pre-tax account and the after-tax or tax-advantage type of account, and you're going to split your $100,000 annual withdrawal between the two different buckets. So you're going to take $50,000 from the pre-tax bucket and another $50,000 from your tax-free or after-tax bucket. So what that means is only the contribution, only the withdrawal from the pre-tax bucket is taxable. So if you're reducing your taxable income from $100,000 down to $50,000, because of our marginal tax rate system that we live in here in the U.S., your tax rate, your average tax rate is going to probably go down, right? So let's say that you lower your tax rate down to 20% because you're only claiming $50,000 of taxable income for the year. 20% of $50,000 leaves you with $40,000 after tax. And then if you were to take the other $50,000 from your Roth, from your after-tax bucket, you don't owe any taxes on that withdrawal, so you're left with $50,000 after tax. So the total between the two withdrawals adds up to $90,000, whereas if you had taken 100% of your withdrawal from the pre-tax retirement plan, you'd only be left with $75,000. So obviously, I think we could all say that if we had another $15,000 a year to spend on expenses rather than give it over to the government in taxes, we'd be much better off. So that's just all to say that if you are mindful of the way that you're balancing or building up your wealth in different investment accounts over time, you can have more flexibility in retirement around taxes. So this little graph here, this little illustration saying, what if tax rates were to go down? Well, if we had balance between these three different buckets, if tax rates go down, no problem. All we do is take some from the pre-tax bucket because tax rates are more favorable. We pay 100% tax on those withdrawals, but it's okay if income taxes are low. Then fast forward, and if tax rates actually go up, then no problem either, because we've actually paid taxes on a portion of our retirement savings already many years ago, and we have this Roth bucket or after-tax bucket, and we can take from that tax-free. So it basically creates a situation where it doesn't really matter what's going on in our economy, doesn't matter if tax rates are lower, tax rates are higher, doesn't matter who's in office, really. If we have some balance between these differently taxed investment or savings vehicles, then we have flexibility around taxes in retirement, and we can control how much in taxes we pay, more so than just having the government dictate to us how much we have to pay if we were, stuck with just this type of the pre-tax type of savings for retirement. So hope that makes sense. We can go over any of that again here if you want to dive a little bit deeper in our Q&A session, but that wraps up kind of our formal presentation for the day. And before we go into the Q&A time, I just want to talk to you real quick about what it looks like to follow up with us and have us actually sit down with you and give you a complimentary consultation. We have an offer out to any of our members to sit down with us for a complimentary consultation and evaluation of your situation. What that time is a time to sit down and discuss your situation, give you some on-the-spot feedback, give you a review of how on track for your financial goals you are, namely retirement and any other big financial goals that you're working toward, and then answer any specific questions that you might have, along with explain our process and where to go from there on how to take steps toward improving your situation. So would encourage all of you to take advantage of the opportunity to sit down with us for a complimentary consultation, and we're going to be sending out an email to you with information on how to follow up and actually get that scheduled. So next for Q&A, I'm going to actually hand it over to Patrick here, and he's going to give some instructions on how to get going with our Q&A time.
Thanks, Michael. At this time, we invite our attendees to submit questions for the Q&A section by selecting the Q&A module at the top right of the screen. That will bring up a dialog box, and you just submit your question in there, and Michael will be responding to it directly. We will hopefully get to all the questions, but if we run out of time, we will definitely respond via email. Let's see, do we have our first question? I will turn it back over to Michael.
All right, thank you. All right, looks like we do have a first question here. Question is, could you repeat the amount of money one can gift tax-free to someone else? So that's actually, so there's a difference between gift tax or estate tax upon death, and that's what we were actually referring to earlier in our presentation here today. So there's an exemption level. If you were to pass away, your overall value of your estate is subject to estate tax, or if you're gifting the money to charity or another individual, there is gift tax. And so the exemption level is $11.2 million for individuals and $22.4 million for households. And so if you don't have a net worth or an estate value of over one of those amounts, then there's no estate tax at all. That's different than the gift tax while you're still alive, which is up to $14,000 per donor you can give to any beneficiary. So you as an individual can give up to $14,000 gift tax-free to really anybody you want. Hope that answers the question. Next here, let's see here. Need to get this to open up here. Sorry, I got to make this larger to be able to see the whole question. All right. Next question here is, can you explain a backdoor Roth and where it makes sense to do that? You're 46 years old and most of your retirement is tied up in 401ks, et cetera. Yeah, a backdoor Roth contribution. So what this is referring to is anybody that makes over a certain amount cannot contribute to a Roth IRA directly anymore. So for individuals, that income threshold, that income maximum, is $120,000 in annual income, I believe. And then for households, I think it's increased for 2018 up to $190,000 of earned income for households. If you're earning more money than that each year as a household or an individual, you're not eligible for a direct contribution to a Roth IRA. So one of the ways, kind of a loophole in our tax system, is that to get money into a Roth IRA, if you're earning more than that amount annually, you can contribute to a traditional IRA, and you don't take a tax deduction on your contribution to the traditional IRA. You just contribute to that traditional IRA with after-tax money, and then you immediately convert that traditional IRA to a Roth IRA. And that's just some extra paperwork, some extra forms that you have to file. Any financial institution or financial advisor should be able to walk you right through that. If you're kind of a do-it-yourselfer and you're just using the, whatever financial institution you do your investing with, the representatives there should be able to walk you right through exactly what forms you need in order to make that happen. Now, one of the things to be mindful of with that is if you have any money in an IRA, a traditional IRA that is, while you're trying to do this strategy, you could be subject to being forced to convert all the money that you have in your IRA to get any money over into Roth. So it's a complicated caveat there. There's a little bit more to it, probably beyond the scope of our conversation here today, but just be sensitive to the fact if you're trying to do a backdoor contribution to a Roth IRA, be sensitive of the fact that if you have existing traditional IRA money, meaning existing pre-tax traditional IRA money, you might be at risk of being forced to convert that portion too, and you could create a big tax situation for yourself. So hope that helps. Next question here. What are the income limits for contributing to a Roth IRA? So we just covered that. I believe it's $120,000 for individuals for 2018, and it went from $180,000 to $190,000 for 2018 for households, for married filing joint. Let's see, next question here. Can you and does it make sense to convert a traditional IRA to a Roth? Yes, you can. We've been talking about that so far. That seems to be kind of the hot topic here today, is getting money from traditional into Roth, or just getting money into Roth in the first place, because that's the tax bucket that, you know, has the best tax treatment down the road. Now, can you and does it make sense to convert a traditional IRA to a Roth? Well, the thing is, you have to pay income tax on any conversion from traditional IRA to a Roth IRA if you have taken a tax deduction on your contributions to that traditional IRA when you put the money in. So if it really is 100% or all pre-tax money that's sitting in that traditional IRA, when you convert to Roth, which anybody can do for 2018, you have to pay income tax on it. So be careful, because if you do that, if you convert from traditional to Roth before age 59.5, you'll actually have to come up with the tax consequence or the taxability of that conversion with out-of-pocket money. Otherwise, if you take the money from the IRA to pay the taxes, you're subject to a 10% early withdrawal penalty. Again, that's if you're you know, before age 59.5, younger than age 59.5. So if you're in that case, if you're in that age group, be careful and make sure that any taxes that you might owe from the conversion of traditional to Roth, you are able to come up with out of pocket. Otherwise, it's going to be a pretty expensive event. If you're close to retirement age, you know, it can be a good idea. I would say that, you know, a better thing to do if you're, you know, or kind of a more common thing that we're talking about with people who are close to retirement, if they are federal employees, is just taking the opportunity to contribute to the Roth TSP between now and the time that you retire, so that you're building at least as much as you can into Roth while not incurring any extra taxes for yourself by doing a conversion from traditional IRAs to Roth, because that can bump you up into another tax bracket. You know, tax rates went down here this past year or for 2018, but it's still, you know, taxes aren't necessarily so cheap that they're nearly free or anything. If you are claiming extra income because of converting a traditional IRA to a Roth, then it can bump you up into the next tax bracket, and it might not make sense. So we'd rather focus on ways going forward that we can get some money into Roth status, which for federal employees is the Roth TSP option or the backdoor Roth IRA strategy that we previously discussed here today. So let's see. Please talk a little bit about the deduction for elder care. Specifically, does the elderly person have to live in your home, or can you take a deduction if you spend a certain amount of time per week paying bills, going to appointments, shopping, etc.? I definitely appreciate that question. It's a fantastic question. I'm not well equipped to answer whether or not, or like what the limit is or what qualifies for that or not. I know that obviously if somebody is living in your home and you are essentially taking care of all their needs, they're basically like just, you know, pretty much the same as a child living in your home. Then obviously you get that $500 tax credit for dependents, but I would definitely consult with a CPA. Whoever your tax advisor is, consult with them before you go ahead and claim that tax credit, because I wouldn't want to steer you wrong. So sorry, I can't help define it a little bit more than that for you. Please explain what taxes are imposed in the after-tax or tax-deferred bucket, Roth IRA, municipal bonds, when taxes are imposed. So the question is, can you please explain when taxes have to be paid on the after-tax tax-deferred bucket, which is a Roth IRA, Roth TSP, municipal bonds, cash value life insurance, or specially designed life insurance? Your taxes are paid on contributions. So if you were to put in $10,000, for example, into an account like that, you would do so with after-tax savings that you have. So you don't get a tax deduction on your contributions to that. I'll compare it to your TSP or your 401k. As you're contributing to those pre-tax retirement plans, it's just deducted right off of your income for the year, and that actually comes right out of your paycheck when you contribute to that, and it's a before tax or before withholding type of expense or contribution going to your employer plan. For Roth, it's just on the opposite side of the tax equation. You're paying it with after-tax money, or your income, your paycheck. The after-tax portion is what you're contributing to the account. And then from there, the great thing about it is the account is never taxed again. So it can grow tax deferred, and you pull the money out income tax-free in retirement. That type of bucket is not necessarily better than the pre-tax or traditional type of retirement savings account. They're basically, the two are indifferent. I mean, they're just taxed differently. One's on the opposite side of the tax equation from the other. So the way that you benefit with a Roth TSP or Roth IRA is if tax rates are actually lower right now than they will be when you pull the money out in retirement. And the way that you benefit from a traditional TSP, traditional IRA, or regular 401k is if tax rates are actually higher now than when you pull the money out in retirement. So if tax rates stay exactly the same, then the difference between a Roth versus a TSP or traditional IRA is nothing. They're the same. The tax rate is the same. So the reason why you want to have a balance of both is because you'll have options to choose from based on how tax rates play out in the future. Right now, we're actually in a period of time where income tax rates are really low, historically speaking. The highest tax bracket for federal income tax just moved from 39.6% down to 37%. And actually, the average historical high tax bracket is 57%. So that's just the average. That's not the highest it's ever been. It's been, the highest tax bracket has actually been over 90% back in the kind of post-World War II era. And to be clear, it was 90% plus for anybody earning over $2 million a year back then, and so even today that would be a very handsome annual income, and not many people qualified for that. But it's not to say that tax rates weren't high for everybody else. They were really high for everybody else. And so again, that was during the post-World War II era, where we had just spent a lot of money as a country on the war and things like that. And so the way to make up debt that our government incurs is through taxes and inflation. Usually it's a combination of both. And so right now, as we're going deeper and deeper into debt as a country, it's an inevitability, realistically, that we're going to have higher taxes and probably some inflation down the road. We just don't know how quickly, how much, exactly when. So over the next 10 or 20 years, we might think that tax rates are going to be going up. But that's what we thought last year, and tax rates came down a little bit for each tax bracket. Now, I know deductions and things changed, and for some households, your tax rates might not really be going down, but all things being equal, I'm just trying to say that we don't know exactly what taxes are going to be like down the road 5, 10 years from now, much less 20 or 30 years from now. And so you want to give yourself options to choose from as you go about life in retirement and withdrawing income from these various investment accounts. So if you've been strategic about it, you'll be able to just go with the flow and choose to take a little bit more from your pre-tax bucket, take a little bit more from the after-tax bucket if tax rates are high, and manage taxes that way. So hope that's helpful. There aren't any more questions popping up here for now, unless I'm not seeing something here. Patrick, do you want to wrap us up? So thanks for attending here today. Would love to follow up with any of you that have any questions for us. after the fact here, and if you'd like to schedule a consultation, please look for an email coming out to you. But I'm going to hand it off to Patrick, and he's going to kind of close us out for today. Thank you.
Thanks again, Michael. That wraps up our Tax Savvy Financial Planning webinar. Once again, an archival link will be sent to you in the next couple of days. In the meantime, if you have any questions, please don't hesitate to contact us. Thanks again for your time and your attention. Goodbye.